Okay, hello, and thank you all for joining us today for this webinar discussing low oil prices, the coronavirus, and the future of Gulf economies. My name is Raymond Karam, and I'm the Chief Program and Development Officer here at AGSIW. The session today is the second program we host in the virtual format due to the COVID-19 pandemic. One of the few silver linings of this crisis is that it has enabled us to bring in more easily important expert voices from the region, and we're happy to welcome with us today Areije Shakar, Senior Vice President at the Bahrain Development Bank and Director of Al-Waha Venture Capital Funds of Funds. Dr. Nasser Saidi, Founder and President of Nasser Saidi and Associates, and the former Minister of Economy and Industry of Lebanon, as well as the former Chief Economist and Head of External Relations at the DIFC Authority, and Ziad Daoud, Chief Middle East Economist at Bloomberg Economics. The webinar will be moderated by our colleague, Robert Mogielnicki, Resident Scholar at AGSIW. The webinar format has also allowed us to reach unprecedented audience members, and I'm happy to say that we have 375 registered attendees this morning, tuning in from every corner of the globe. A disclaimer before we start, the webinar today is being recorded and will be made available on our website tomorrow. Also, a reminder to our audience, you are in listen-only mode, but you will be able to ask your questions through the Q&A function in Zoom, and you can also email us at info@agsiw.org or tag us on Twitter at Gulf States Inst. With that, Robert, over to you.
Great, thank you very much, Raymond, and it's a pleasure to welcome our audience to this discussion during what are very challenging times. I think on the bright side, though, we're all now Zoom experts and very skilled with virtual meetings. So these brief housekeeping items will come as no surprise to everyone. First, there might be disruptions, but don't worry. If a speaker cuts out, they'll join right back in and we'll loop them back in. If I cut out, Raymond will continue the conversation in my absence. And he also mentioned that we have 375 guests joining us today. So if you would like to ask a question, whether it's on the Zoom app, Twitter, or via email, please direct your question to a specific individual and keep it short. And that will help me direct the questions to our speakers and ensure that there's a higher likelihood that your question will be asked. And please fire the questions away right from the beginning. We're going to open with a few questions to the speakers, and then I'm going to turn it over to the audience in the middle of the presentation today, which will last for about an hour. And before that, I'm going to take just a couple of minutes to briefly set the scene for our discussion today. As we know, the coronavirus outbreak is wreaking havoc across the globe, but Gulf economies seem especially vulnerable owing to the existence of multiple interrelated crises. These states have urgent spending needs, but their fiscal resources are also constrained. We know global oil demand is down in large part due to the stringent measures being undertaken to combat the coronavirus. And oil market dynamics have highlighted that Gulf governments remain precariously dependent on hydrocarbon exports, despite decades of economic diversification efforts. Even those segments of the economy that have been earmarked for economic diversification over the years, I'm speaking about aviation, tourism, logistics, these are also struggling at the moment. And to make matters worse, we're in the middle of an oil price war between Saudi Arabia and Russia that has sent oil prices plummeting. Now, we might be nearing a deal between major oil producers, but there are still serious concerns lingering whether there will be demand destruction related to the industry. And of course, the last few weeks have given really a new meaning to the notion of low and volatile oil prices. So, this has also come at a time when the budgetary needs of Gulf Arab states are as great as ever. And when we started this event, we calculated that Gulf governments launched economic stimulus packages totaling around $97 billion. But just in a few short days, that figure has now reached between $130 and $140 billion. And I expect that various measures are yet to be implemented and that figure may yet increase. So what does this mean for Gulf economies? What about economic reform agendas? And is a recovery in sight? What will it look like? These are complicated questions, but we have a great group of speakers today to help us make sense of this. Raymond already went through the speakers. Their extended bios are on our website. So I would like to just jump right in with a couple of questions for our speakers. First goes to Ziad. Ziad, how vulnerable are GCC states to these new market shocks that we're seeing and the impact of coronavirus? And beyond oil prices and the break-even price of oil, what economic indicators do you think our audience should be paying close attention to?
Well, thank you, Rob, and thank you, Raymond, for first organizing the seminar, this webinar, and also for inviting me. I think in terms of exposure to the two shocks, obviously there's a huge exposure. If you start with the coronavirus, the GCC, much like the rest of the world, is exposed to the outbreak of the virus. We know that the virus is spreading widely. We know its economic costs are large. We think, much like everyone else, that the second quarter of the year, we're going to see a large contraction in global economic activity, probably the deepest on record. Now, globally, people are debating whether, the path of subsequent recovery. Some people think that the downturn is going to be deep but short in what is called a V-shaped recovery. Others think that the downturn is going to be a prolonged one before we get an upturn in a U-shaped recovery. I think for the GCC, the relevant shapes are not V nor U. There's a risk that we might end up with an L-shaped growth, where growth permanently shifts from a higher level to a lower one. And the reason why I say this is twofold. First, on top of the coronavirus, the GCC, as you mentioned, is exposed to the decline in oil prices, which is sharp and very big. And we know from historical experience, in fact, recent historical experience from 2014, that such decline in oil prices results in a permanent change in growth. We know that non-oil growth in the GCC declined from something like 6.7 before 2017 to around 2 to 2%, 2 to 2.5% after that. So we'd expect the same dynamics to be at place this time around with the decline in oil prices. The second reason why we expect there's a risk of an L-shaped growth is because in order to get the subsequent recovery, you need a stimulus measure, or you need a stimulus package that is large and that is in line with the size of the shock. And this has been absent in the GCC. If you think about the virus shock, what it does at a very primitive level is that it shifts consumption and production from the present to the future. So people consume less today, they produce less today because they're staying at home. But once the virus effects fade, once the containment measures are lifted, people consume more and they go back to work and they produce more, making up for the lost output. But in order for that to happen, in order for them to go back and produce in the future, you need companies to continue to exist rather than going bankrupt. You need individuals to continue to be employed rather than being laid off. And in the case of the GCC, given the structure of the labor market, given its reliance on foreign workers, you need these workers to remain in the GCC rather than leave in droves. And for that to happen, companies and individuals, probably very few people and very few companies can sustain themselves with zero revenue and no income for 2, 3, or 6 months, depending on how long the virus shock lasts. So for that, you need a stimulus, in particular, you need the fiscal stimulus. You need higher government spending to offset that, to keep companies alive and to keep workers in place. And in the GCC, we have not seen a fiscal stimulus. We've seen measures that include liquidity injections, that include deferred, taxes and fees, but we have not seen increased spending. If anything, Saudi Arabia, we've seen spending, plans of spending cuts, and that's basically makes Saudi Arabia the only country in the G20 that is cutting spending in the middle of probably the deepest downturn on record. So for that, we think probably there's a big risk that we might get a level shift in growth and an L-shaped type of growth.
Great. Thank you, Ziad. I'm going to shift over to Nasser. Nasser, what avenues do GCC states have to address deficits amid revenue constraints? And what do you believe to be the advantages and pitfalls of the various monetary and fiscal policies currently being implemented in the region?
I think let's go back to the nature of the shocks the GCC countries are facing. In fact, there are 3 types of shocks. There's the COVID and global economic shock that we're now living. We're now entering probably into a very deep recession at the global level. We don't know how long it'll last because we don't know how long the unfolding waves of COVID will persist. So that's one factor. And this matters for the GCC countries because of their reliance on trade, their reliance on tourism, and overall in terms of their greater integration into the global economy. And this brings you to the second shock, which is the oil shock. And these are both because of COVID and the decline in aggregate global demand, but also because of the price war that is now ongoing within OPEC plus, and which is also likely to persist in the future, because it's not simply a price war, it is a price war against shale oil. This is going to be, let's call it a structural war, because you have to face the fact that shale oil has been replacing some of the oil of the GCC. And if you look at the share of the OPEC countries, it's come down from some 40% in 2015 to about 34% now. So that price war is with us and is likely to continue. But the third shock is the financial markets shock. Remember that the GCC countries, of course, are all net foreign capital exporters. The sovereign wealth funds and investment funds are all invested heavily into the market. So you've also got a financial market shock. Now, how do the GCC countries typically respond? We've had a couple of shocks of this type. And typically what's happened is you've had pro-cyclical policy. What Ziad was pointing to is that typically when you've got this revenue shock, and now you've got a 40% to 50% decline in revenue across the board in the GCC, there's typically a reaction of let's maintain the budget and cut down spending to fit revenue. And of course, what that does is it means that the non-oil sector gets negatively affected. So the oil shock transmits itself into the non-oil sector. And major problem, and let's face it, there are the policy constraints. There are two types of policy constraints. The first one is in terms of monetary policy. All the GCC countries are pegged to the US dollar, and that means they have to follow US monetary policy. The second constraint is that you don't have any automatic fiscal stabilizers. Most of the Western world, US, Europe, and other, have automatic fiscal stabilizers. Tax revenues decline, people pay less in terms of taxes, you've got unemployment insurance, you've got transfer programs, and the rest. You don't have those fiscal tools within the GCC countries because the tax system has never really developed. You were always relying on revenue. The second part in terms of additional fiscal constraints comes with respect to monetary policy. Because you're pegged to the US dollar, the GCC countries have always relied on the banking markets and international financial markets rather than developing their own financial markets. As a result of that, when you're trying to inject more liquidity, you can't conduct open market operations because there isn't the instruments in the market that you can buy and sell. You can't really conduct QE as has been happening in terms of Europe and the United States. And as a result, you're much more constrained. So what is likely to happen? You've got a big fiscal shock and a big revenue shock. I expect that budget deficits are probably going to soar to the extent of about 10 to 15% of GDP. Those are large numbers, but you have the capacity to borrow. If you look at overall debt within the GCC countries, it's about 33, 34% of GDP. So you have the ability to borrow. Some of the countries are a bit more vulnerable. Bahrain is, Oman is. Other countries have fiscal buffers. UAE, Saudi, Qatar, Kuwait have fiscal buffers and sovereign wealth buffers they can tap into in terms of helping them finance whatever programs and stimulus programs. The stimulus programs that have been announced to date, just to go back to your initial introduction, are now running to about 170 billion. Yeah? UAE announced over the weekend on Sunday a big stimulus package coming from the central bank to the tune of about $70 billion. So if you look at the total, we're talking about something like 10% stimulus package for the GCC countries. Now, the issue, that looks like a large number, but it is not, in fact, additional spending. Typically, what's happening is that you cut down capital expenditures. You have a pro-cyclical fiscal policy, which of course makes the downturn even worse. Much of the stimulus that is being provided is monetary and financial stimulus going through the banking system. And so to come round to your question and where we're heading, a lot of it will depend on how the banking system will be able to translate the financial and monetary stimulus into additional loans or forbearance in terms of loans, mortgages, and the like. And how do you address distress in the system? What I mean by distress is you've got a number of sectors: the real estate sector, tourism and hospitality, airlines. You've got major airlines in the region, both in UAE, Qatar, and others, which are highly dependent on international transport. Well, international transport is not likely to pick up very soon. And in addition, you've got a regional factor, namely religious tourism. The Umrah was cancelled in Saudi Arabia, and it may very well be that Saudi Arabia, because of health concerns related to COVID, might have to cancel the Hajj. It's happened in the past. There have been some 40 occasions in the past where the Hajj has been cancelled, but that could be on the cards, which would be an additional shock. So a question would be, how does the financial stimulus, monetary stimulus go into the system? You're going to have to address some of the distressed sectors I mentioned, airlines, real estate, tourism, and related. And of course, real estate is a big one. We're already facing a crisis because there's been some overbuilding. So, big question moving forward. How do you deal with the private sector? Because if you really want to diversify your economy and to be able to face up to the shocks, you can no longer rely on the government sector. We've seen that after the great financial crisis. We've seen that in 2014, 2015. The private sector has not picked up activity away from the public sector. And what you need to do now is to focus much more on privatization, on public-private partnerships, and also start to think of new policies to address the free zones. If you look across the GCC, particularly the UAE, to a lesser extent, Saudi, but Bahrain and others, all of them have started to develop free zones in order to attract foreign investment and in order to attract capital and know-how. But those free zones are not going to be helped by many of the financial packages. The financial packages that have been introduced are mainly for, let's call it, the domestic economy.
And that's an important point, Nasser. I think you and Ziad have both pointed out that it's very important to separate the economic stimulus announcements from actual spending measures. And I think that's a very important point we're going to pick up on again just a little bit later. I would briefly, because you mentioned the private sector, and I thought it was a perfect opportunity to move over to Areije and ask her how Gulf businesses, in particular SMEs and entrepreneurs, are dealing with these fast-moving changes in government measures.
Thanks, Robert, and thank you so much for the opportunity. I feel very humbled to be amongst both Ziad and Dr. Nasser. And, in this, my very first virtual panel, so disclaimer to the audience, if I don't sound well or I'm fidgety, it's just my first time on a virtual panel. I think when it comes to sort of the SMEs and the entrepreneurs, I think, when I think back to sort of when sort of the COVID was, coming out and sort of affecting our region, there was, I think, a point where everybody was in denial, oh, it's not going to affect me as a business. Oh, I don't fit into this category. Oh, it's not going to really come into me. And then, when things started to change and different types of measures started to come in, like the lockdowns and sort of restrictions on different types of movement and activities, then you'd feel like a lot of these businesses started to accept the situation. Of course, there's no precedent for this. No one is able to kind of compare it to anything that has happened before. But more importantly is what happens next. So you see a lot of businesses that still remain in this denial, position, whereas a lot of the others have now started to adapt and adopt different types of measures. So, we were supposed to be in the States having this panel, and we're now, virtually adapting to the situation and not sort of missing the opportunity. And for a lot of businesses, I think this is kind of like the inflection point where you see a lot of the former businesses who didn't believe in e-commerce, a lot of the more traditional SMEs that, felt like, especially in the retail sector where, why, no, this doesn't fit into us. No, our type of business doesn't really fit into this technology kind of box, have now been forced to become a technology sort of savvy or able to deliver the services through technology. And now sometimes at a higher price, because they don't own their own e-commerce platforms and have to sort of plug into other types of e-commerce platforms. I think also something that although there's a lot of stimulus packages that both Ziad and Dr. Nasser spoke about, like it was pointedly said, it is mostly for domestic businesses. So a lot of these businesses might be able to have some cost savings, whether it's reductions in electricity bills, to be able to kind of fit the bill for their, let's say, foreign based workers or teams. But I think what a lot of things that we need to kind of watch for in this kind of period is kind of the quality of the teams and the businesses that are out there. I think we've seen a lot of growth in both types, both sort of like the investor segments, those that are investing in startups and in entrepreneurs, a huge kind of influx of funds that have come out to the region, are interested in the region, and even in terms of startups and different types of platforms. That's not to say that those who are not able to kind of ride this wave into this crisis are not kind of high quality, but I think it's going to be a test to quality in both, the dynamics of teams and the culture that they've been built on, but their ability to kind of wade a situation where there's no kind of like textbook definition of what has been done before. I mean, if I speak just from my personal experience, I have to work at home, and I'm sure, many of my peers on this panel are doing so today. Kind of navigating that space when you're not able to kind of be in touch with kind of like, your team members. And that's going to be kind of the new normal for a lot of these businesses to be able to kind of adapt to. So I think it's kind of a point where we're all kind of recognizing that although the region has been kind of like late adopters to the whole technology, it's even more important today than ever that, our governments have created programs and funds to help support technology and innovation. But now the private sector needs to kind of step up and stop resisting, these changes. And unfortunately, crisis has had to put a lot of these people to make very difficult and now more expensive decisions to ensure that technology is part of their strategy. Namely banks. We spoke about how banks are going to be able to help support this ecosystem. No longer are people going to feel safe to go to a bank and stand in long lines to be able to apply for a loan. If they're not able to do this, technologically or digitally, then these things are going to have to change. And, there's going to be a lot of moves towards services that are able to provide these kind of solutions. So I think, we're on the kind of adaptation phase of the 3 stages. I would like to say the denial, the acceptance, and sort of adapting. And then I think we're going to start to see a huge growth for innovation and creativity that's going to actually spring out of this unfortunate situation.
Great. Thank you very much. I'm going to circle back to Nasser and then also pose a question to Ziad. Nasser, you mentioned sovereign wealth funds. What do you think the role of Gulf sovereign wealth funds will be in the coming weeks and months, and specifically their role as fiscal buffers? And then to Ziad, we had a question from the audience. Sorry, I think it's Hussein in the audience. Hussein Katib, asking about the Oman's debt sustainability and PEG sustainability in light of low oil prices and the weak external environment. Is 2020 the year of crises in Oman? You have spoken at length about the currency pegs in the Gulf. What are your thoughts on those? Which countries look particularly vulnerable? I'll start with Nasser, and then we'll move over to Ziad.
Well, traditionally, of course, the sovereign wealth funds have largely invested outside. The idea was that this would be a risk minimizing strategy. You're already exposed to the oil shocks. You don't have a domestic economy that you could invest in. So you invest outside to get the income and de-risk oil shocks. What we're now discovering, in fact, is that there should be a different role for the sovereign wealth funds. They should play a much more active domestic role. There's a couple of good examples of that. Mubadala in the UAE, for example, has been much more involved in bringing in technology and having joint ventures between foreign investors and technology and domestic. That's a way of transferring technology and capital and know-how. So I think this shock coming after the previous shocks that we've had is the following. You're going to have to ask sovereign wealth funds to play the role of economic diversification instruments for the governments of the region. Why? Well, because they have the financial capital and ability. They can take equity locally. They can do all types of mezzanine type financing. They can go into investing in bonds and other instruments in the markets. They can help develop the financial markets locally. But second, they've learned what types of businesses could be attracted to the region. And they are understanding, of course, of what are the diversification strategies of the countries of the region. So I think two things for the sovereign wealth funds. Number one, you're going to have to tap in to your investments and sell some of your treasury bills that you're now holding, which they've started to do already. I think we're estimating something like 300 to 400 billion that the sovereign wealth funds will have to divest away in order to help the countries of the region. But second, I think there'll be a new view in terms of what should be the role of the sovereign wealth funds. And I think the view will be play a much more of a domestic role, helping local industries, helping innovation, going into introducing a lot of new technologies, helping the countries of the region digitalize their economies, as Areije was mentioning a bit earlier. You're going to have to shift a lot more into digital activities, develop digital assets. And that means the sovereign wealth funds can play a very important role in addressing that. And just quickly, I know Ziad will address the issue of Oman. Oman has recently been downgraded. They've been running large budget deficits. Oman has not adjusted like other countries in the region. Other countries introduced VAT. You now have a VAT introduced at 5% in Saudi, UAE, and Bahrain. Oman, Kuwait, and others have not done so far. And that has meant that you're much more vulnerable when oil and gas prices decline, as has happened. So Oman is under severe pressure, both because it has a relatively high level of debt, but also because of its fiscal situation. I'll let Ziad maybe take on from there.
And just to follow up before Ziad starts, Dr. Nasser, we had a question from Charles in the audience. If you expect Gulf Arab states to increase the value-added tax rate, very briefly.
I don't see that immediately, but you're going to have to have fiscal reform, and it's going to take two parts. You're going to have to introduce corporate taxation. It's on the cards. You now have much more information from the VAT system about what companies do and the revenues and activities and how they're linked to other companies. And second, it'll be easier to introduce a corporate income tax. So I think that is on the cards in the next few years. But I don't see any increase in VAT in the foreseeable future, certainly not over the coming year. If anything, you might see a reduction in VAT simply to provide more stimulus. We've already had countries, including the UAE and others, saying we will delay collection of VAT. And that is important because when you have a crisis like this, it is cash flow which really hurts. Where you really want to help SMEs and other companies is those who have difficulty managing their cash flow, who depend on their daily sales in order to survive, who don't have the banking facilities. And unfortunately, across the Arab world, and including in the GCC, the SME sector barely gets 4 to 5% of bank loans. So they cannot easily go to the banks and tell them, look, I want to extend this credit loan line or I want to increase it. So the main issue is cash flow and how do you help companies and individuals, peoples in the professions in terms of cash flow. That I think is the critical bit. And there, I think that the banks cannot really help the SME sectors as much as they can help it in Europe or the United States. So that's going to be an issue moving forward, and maybe reducing VAT, maybe reducing a couple of other registration fees, license fees, and all the rest is what you'll see on the card. Certainly, that's the sort of advice I'm giving at the moment to governments.
Great, thank you very much. Ziad, currency pegs.
Well, currency pegs resurface whenever oil prices drop, and obviously with the drop in oil prices, that question is resurfacing again. I think point number one, we have to look at the broad GCC. The GCC today is weaker than in 2014 when we had the previous oil price shock. So debt is higher, both external and public. Deficits are wider today. Growth is slower. So across the board, there is a weakness today relative to 2014. But within this broad picture, obviously, there is variation in the strength of the balance sheets, and two countries stand out, Oman and Bahrain, in terms of weaker balance sheet than the rest. Now, Bahrain has already the support of three other GCC countries. There's a $10 billion financial package that was before the recent crisis, was supposed to last Bahrain for 5 years. So maybe that'll be extended, maybe that'll be made larger, we'll see. But 10 billion, if that was enough to last Bahrain for 5 years, Oman is expected to run a budget deficit this year of $10 billion. So it's a single year for Oman. Obviously, it's a big question. I think the key for Oman this year, whether we're going to get a crisis or not, is its ability to access markets. If markets end up being forgiven and allow Oman to borrow from the market, then that will obviously delay the crisis, and that will help it to get through this year. If it doesn't, or if markets don't, then Oman will have to rely on its reserves at the central bank and its assets at the sovereign wealth fund. And if it funds its deficits solely through these, tools, then it's basically assets, liquid assets of the sovereign wealth funds might be exhausted by next year. Now, the key issue here, even if Oman gets through this year, next year is difficult. Let's remember, after the 2014 oil price shock, GCC countries started issuing external debt, and that process started around 2016. So the 5-year bonds that were issued in 2016 will mature in 2021. So the maturity profile of your external debt will basically spike in 2021 and 2022. So even if you get through this year with some access to market, that question will be repeated next year. So am I worried about Oman? Yes. Is there going to be a crisis this year? It depends on market access. But then even if there isn't, next year is another question mark, and we'll be asking the same question again.
Great. Thank you, Ziad. We have a question from Justin Alexander in the audience. What specific kinds of fiscal stimulus packages do the panelists think would be most productive in the Gulf? It's a broad question. I'm going to direct a more narrow version of that to Areije. Both Nasser and Ziad have said that it's important to separate economic stimulus packages that are currently on the table from actual on-the-ground spending. Dr. Nasser also said it's important to get those bank loans into businesses and think about the types of investment in technology and innovation. This is something, Areije, that you're very, very familiar with. What areas within different startups and SMEs, specifically in the innovation sectors we talk about, those technology sectors, do you see as having the most potential in the near and medium terms?
I mean, I think technology and innovation broadly, are going to basically need support. And I think, all of the GCC countries have created different types of funding programs, whether it's, funds of funds or other types of kind of support programs through their labor funds, like we have in Bahrain, to help support, SMEs and their sort of costs. And, when we talked about cash flow needs. I think, even more, this is the time when we don't cut spending in these areas, because this is when these SMEs and startups are going to thrive, and a lot of innovation will come out from this time, because, as we see, back in 2008, a lot of these top, kind of unicorns actually started during the financial crisis of 2008, like the WhatsApps and the Ubers were all born out of these kind of crises. And so what this crisis will actually kind of be born, or what actually will give birth to, we still don't know, because we're still, I guess, at the beginning or at the middle of it. But I think we need to ensure that not only do we have these funding programs through the Sovereign Wealth Fund of Funds, like, Dr. Nasser mentioned Mubadala, we have the Jeddah Fund of Funds in Saudi Arabia. Kuwait also has different support programs. We have, ADIO as well in the UAE, and even, Jordan and other countries that have also created that, even Oman. But these are usually the programs are the first things that people think of cutting off. But the SMEs are really going to be the engine that are going to provide opportunities and job opportunities to help the growth going forward. And so I think this is the time when governments are sitting together to try to address budget cuts or different addressing where budgets go, is that you don't cut off these kind of programs. I think when it comes to SME loans and the cash flow kind of tightness, I think this is where kind of development banks come into play. This is the time where governments can provide stimulus packages that go through these to go through development banks to be able to disperse them out to the SMEs that actually require them. So it's not kind of just like these free kind of packages, but actually geared towards helping support these SMEs during their cash flow crunches that they might face during these crises. At the end of the day, there's no kind of right answer, because we've never kind of experienced this before. But we definitely can say that in any type of crises, it's the private sector and the SMEs that can help turn the wheel forward and to be able to kind of stimulate the economy. And this is where we need to kind of ensure that there is still budgets and funding that are going through.
If I may jump on this, Rob, sorry. In terms of the stimulus and the form, I think the principle, there should be a principle for how the stimulus works. And the principle is as follows. Any company that was viable before the coronavirus shock you should support it, and you should make sure that it remains viable afterwards. The coronavirus shock is not, creating creative destruction. It's a random sweeping destruction, and you should be picky about what goes under and what doesn't. So that should be supported. Now, the form of support can take three forms, and I think the strength would depend on the type, on the composition of the fiscal stimulus. I think the strongest form is actual spending, going out and spending, and we've seen very little of that in the GCC. In fact, probably none. We've seen the opposite. We've seen announcements of budgetary cuts in Saudi and Oman, and others would probably follow suit. The second form, which is less powerful, but it's also helpful, is delayed fees and taxes and all that stuff that helps companies with their cash flows that reduce their costs. It's less effective than direct spending, but it's helpful nonetheless. I think the weakest form, which is the big headline numbers, is in terms of the liquidity injection. Because for that, you inject huge amount of liquidity in the system, but that's only helpful if banks then redirect these additional funding to the real economy. And we're in the middle of crisis. And in the middle of crisis, banks do the normal thing, which is they hoard liquidity because they don't know what's coming next. They don't know what kind of laws will go impaired, so they hoard liquidity to protect themselves going forward. So they become more picky about who to extend the loans to and how. And also people become more reluctant to take up loans. So on the demand side, you'll have issues as well. The issue with the GCC is that the biggest size of the stimulus was in the form of liquidity injection, which is the least effective way. And the most effective thing, which is direct spending, has been cut rather than increased.
And Dr. Nasser had a follow-up about central bank swaps.
Well, just to come back to this issue of liquidity and injections, I fully agree that the problem is that you're not going to be able to get all that liquidity to the SMEs and the others who actually need it. Because of the uncertainty, and it's going to last, banks will hold back. And it may also be that you also have governments playing a role in taking away liquidity because they're going to have to borrow. Typically, the GCC countries are going to borrow from the banking system. they're not going to be able to access international markets. If you take the case of Oman, it's already been downgraded. Bahrain has been downgraded from to stable. So the GCC countries are going to face an upward sloping cost in terms of access to the markets, and they're going to have it much more difficult to access to the markets. What do you need to do? This is the time, I think, where you start needing some cooperation. You need some central bank swaps, between the central banks of the region. Some of them have plentiful liquidity. Others, like Oman or others, and Bahrain, might not have that. Establish some central bank swaps between the countries of the region. The larger ones can tap the Fed. The Fed has now announced swaps. We can tap those. You can tap the Chinese. So let's introduce really some new instruments. Second thing that needs to happen is you need to avoid this crowding out of the private sector. So let the governments issue treasury bills and bonds, to tide them over the difficult period we're going to have over the next year, 18 months. Let those get bought by the central banks. It's not something I would normally advocate. I wouldn't normally advocate monetizing deficits or monetizing debt, but this is an extraordinary period. And this is the time at which the countries of the region, in order to increase spending, and there's nothing wrong with increasing spending and targeting that spending, issue debt and have it bought by the central banks as opposed to the banking system. And the reason why that's so fundamental is that we have not grown our financial market. You don't have a treasury bill market. You don't have a government debt and bond market. You need those so that you can face shocks in the future. You can inject liquidity. We don't have open market operations. We can't undertake QE. All the panoply of tools and instruments of monetary policy that are available elsewhere are not available to us. So this is a time at which you start introducing some structural reforms of that type.
Thank you very much. We've had a number of questions about migration flows. So I'm going to direct this question to Ziad, and we have Priyanka, Justin, Mohsen, all have asked questions to this effect. What do you perceive to be the impact on expatriate residents in the Gulf region, and what are some of the what would you view as the successful measures to counter the negative effects and impacts on expatriate workers, and what do you view as measures that might have not been so successful? Please.
Well, if given the size of the downturn, again, we're talking about probably one of the deepest downturns on record. Could be short, but it's definitely very deep. In the absence of stimulus, you'd expect people to be laid off, and we're seeing that process starting, not just in this region, not just in the GCC, but globally. You have a legal structure here that if you don't have a job, you need to leave within a certain number of days in the GCC. And given that, you might this might result in expatriates leaving the GCC in droves. So in the absence of stimulus, that process could happen in place, or could happen. We've seen, for example, Saudi Arabia has decided to subsidize the salaries of workers in the private sector, but it focused only on Saudis, on citizens. It didn't extend the coverage to expatriates. So that doesn't prevent that process from happening. And that creates issues, because in the absence of stimulus, if this process of expatriates leaving in large numbers take place, then that will have macroeconomic consequences. You build capacity for a certain number of people, and all of a sudden you have a large number of people leaving. You already have the problem of excess capacity in a number of countries here after 2014, and that's very visible in the real estate sector, but also in other sectors, and that will exacerbate that issue. So that will have a feedback loop onto companies here. So if the current trends continue, then you might have an issue with migration flows in the GCC, and I think the only thing that could prevent it is a sizable fiscal stimulus that lives up to the size of the shock.
But I think you also need to go a bit further than that. Helping in terms of wages and salaries is certainly a measure that you could introduce, but I think we need to look a bit further. You need some structural reforms. This is the time at which you need to start thinking of introducing a pension system and social security into the GCC so that expatriates can contribute to that, but also benefit from that. You don't have an unemployment insurance system in the UAE or any of the GCC countries. This is the time to start thinking a bit outside the box, outside the traditional. The point about the expats is that they have a lot of human capital that they've contributed, but also they are major investors into the domestic economy. They are many of the companies that provide diversification. So you really want to hold on to that human capital rather than have that leave the country. How do you do that? Review your immigration policy. Think of visa systems allowing them to stay. Have a lot of forbearance, but also start thinking in terms of how do I introduce an unemployment insurance system? How do I introduce a pension system? And remember the benefits that can come out of that. It means that you would retain a lot of the savings in the GCC countries that now go out into remittances and don't get invested back into the domestic economy. So this is the time, I think, at which you need to review immigration policy, visa policies, but also think of what sort of stabilizers you can put in place to help when you get the next shock.
Great. Nasser mentioned that expats are important investors, are also entrepreneurs in the region. Areije, this is an area you're very familiar with as well. What do you see as the role of governments across the region in prioritizing some of this investment and spending so that it reaches these expatriate entrepreneurs and also creates a space where there are investments for SMEs and for entrepreneurs?
I think Ziad was just mentioning earlier about during this time, this is when banks and sort of investors kind of hoard money because they're unaware of what's going to happen. And that's precisely perhaps how some of these government programs are going to start to look at, their different fund of funds that are investing in these, venture capital funds as well as direct into these kind of startups and the talented kind of companies that are coming out of the region built by expats or locals. I think one thing, and this is sort of an opportunity, and I think it ties a little bit to a question that I see here from Sharif, is that how do sort of the countries, everybody's been racing to become, technology HubSpots and, startup kind of havens for, and this is the opportunity for countries to not stop spending and to actually be on the lookout for great innovative opportunities and to actually invest and back, great venture capital investors as well as great startups. Because, yes, some people are going to struggle just because of the situation, but doesn't mean that they were likelihood not to have survived if there wasn't, a crisis that we wouldn't expect such as this. And I think this is where governments need to kind of not close shop, but actually be much more aware, much more on the lookout and monitor a lot of what the activity is happening, because a lot will happen. And I think that more than ever, this is the time where countries can actually kind of, take their place to become the, I guess, backbones of innovation and creativity that will come out of a lot of these different ecosystems.
Areije, are there any great examples you'd like to point to toward startups, Gulf-based startups that are thriving at the moment? I mean, whether it's in e-commerce, last-minute delivery, digital payment platforms, any kind of highlights that you would like to mention that are an example of these companies that are actually managing to thrive in this very difficult environment?
I think if I were to just speak sort of like in Bahrain, we have a startup called Baqalat, who a lot of time was kind of put aside and not given a lot of attention to just because, there was no reason for their services. And in the month of March, their sales and revenue basically went up over 150% just because of the situation. And so no longer were the struggles and again, the denial and like lack of, adaptation or adoption, those reasons that a lot of these businesses were putting into place. And that's, e-commerce along with sort of, platforms that help support these businesses, but more importantly, last mile, because, a lot of, retail places want to provide delivery or want to be able to access their customers. And all of a sudden, last mile that was kind of being dropped off and not considered to be important is now, becoming top of list for a lot of these startups. And if you look at, across the region, and when we talk to, fund managers within our portfolio, more than ever, food delivery and e-commerce platforms and last mile are coming top of list. But a point, I think we discussed this probably before the panel started, was I think Dr. Nasser mentioned about regulation and the regulatory framework. I think this is also an opportunity for governments to become much more fast-paced and move, because, there are going to be little types of regulation that doesn't fit into the box of some of the solutions that some of these businesses may require to be able to operate during these times. Then there needs to be kind of fast responses to be able to adapt to these things. And with an innovation as well, if it took, 6-7 months to get different types of digital licenses for some of these financial services, there needs to be kind of like, a fast track for the COVID times. And I think more than ever, people think that this is a lull in time and people can take a little bit of a nap, because, nobody's looking. But actually, the ones I think we need to be more alert as governments, and I think businesses need to take advantage and start to innovate and grow.
Thank you.
Can I just come in quickly on this, because I think it's important. Part of the problem is the fact that your work permit, particularly for expatriates, is highly restricted. Yeah, we need to liberalize that, and I would advocate having a work permit across the GCC so that people can move across the GCC countries. You need that labor mobility, not only domestically, but also across countries. The second point, I think, has to do with the fact that we talk a lot about innovation, but this is not going to happen very quickly. What you need to do right now is to help SMEs, small companies, and the rest by ensuring that they have a market. And typically that's related to the larger companies, and the larger companies are government-owned companies. Saudi, for example, has gone ahead. So Aramco now has a program for SMEs. You need to multiply that. They need to get integrated into the supply chains. That hasn't happened so far. So you need a little bit of innovation, I think, in terms of regulations, but also allowing, say, part-time work. Many of the regulations across the GCC countries don't allow for part-time work. That hurts women because they want that flexibility in terms of being able to work or work from home. You need to be able to use digital instruments, so digital working, telecommuting. That requires changes in laws and regulations. So I think that should be on the agenda and accelerated. Why can't I set up a just simple digital company? I don't need a place to work. I can just work straight from home on my PC. Whereas most of the rules and regulations in terms of establishing companies require you to have physical space. So reducing the cost of doing business is something you can do immediately and accelerate really the setup and establishment of businesses. That's the sort of thing we need to do now.
Thank you. And over to Ziad, there are examples of other crises. We mentioned them a bit in our talk today: 2008, 2009, 2011, 2014, and early 2015. What lessons do you think GCC policymakers have learned from these periods? And do you see them taking any of these lessons to heart at the moment? Also, a follow-up question there is coming from the audience is if we look back at some of these crises, wealthier GCC states have extended packages, can rescue economic aid packages to some of the less wealthy GCC states. Do you expect that happening?
Right. So you've enumerated a lot of crises in the 2000s. I think what we're having today is basically probably unprecedented in terms of depth. Certainly, maybe not in terms of duration. We have a demand shock from the coronavirus, and we have an oil supply shock as well. The combination is we have in 2008 plus 2014 put together in a single quarter. So it is huge. I think the lessons that we need to take is basically, number one, the world is unpredictable. Every single institution around the world did the 2020 forecast in December. Nobody has foreseen that a virus would make us sit at home for a number of weeks and months. And if the future is unpredictable, then you need to build your resilience at a time when things are basically going well. When oil prices were at $70 or $60 per barrel, you need to do the difficult stuff because you have the space to cushion the shock, rather than doing that in the middle of a crisis, which creates a complete sudden stop in the economy. Have we seen that happen? Fortunately, not very much. So we're the fiscal policy is becoming basically pro-cyclical. We're increasing spending when the economy is doing well, and then cutting spending when things are doing not so well. So that's the concern that I have here. What's the second question, Rob? Sorry, I missed that.
The question from the audience was, do you expect wealthier GCC states to extend economic aid packages to some of the more vulnerable states?
Okay, so we're talking here about basically Bahrain and Oman. Bahrain is already under a financial package. $10 billion over 5 years may not be enough in the current circumstances. Whether that will be expanded or front-loaded to this year, we'll see what happens. In terms of Oman, is a big question mark. That's what everyone is asking. But I think there's an important point here, which Nasser alluded to, which is the fact this is a global crisis. So not only do you need regional cooperation, but you also need global cooperation, because some countries have more space than others. Countries which have independent monetary policy, which have fiscal space, they could do more. We're talking about advanced economies. Emerging markets which are facing capital flight, which are facing commodity price decline, which have more restricted currencies, they might need help. And this is a global crisis where the global economy is heading in one direction, which is south, and it might require cooperation across borders. It might require advanced economies to help emerging markets. So if that's happening on a global scale, it makes sense for that to happen on a regional scale. We're talking, about central bank cooperation. We're talking about coordinating health policy, which is very important in the current environment, but also coordinating some of the stuff and getting help from the weaker, from the stronger nations to the weaker ones. I think that is very crucial in the current environment.
I think just to pick up on that, I think, again, this is the time in terms of crisis where you have to think outside the box. This is the time where you need a solidarity type fund, across the GCC countries, because the shock is common to everybody and does not exclude anybody. And the problem is that this shock is going to persist. The troubles in the oil market are not just a simple price war at the moment. It has to do with the fact that oil and gas faces an existential threat from renewable energy and from shale oil and gas, and the outlook for oil prices is on the downside, not on the upside. That means you have to focus increasingly on diversification policies. And that means, we need to come back to it, it means focusing on the role of the private sector, opening up many activities in sectors which are now government controlled or invested in, and opening them up to the private sector. That's the sort of thing that needs to happen. The pace at which it can happen in different countries is going to be different. And that is why you need something like a solidarity fund. This is the time to start thinking in that direction.
Great. And just to follow up for Ziad, this is coming in from the audience as well. Beyond aid to GCC states, Oman and Bahrain, what about aid from the wealthier GCC states to other Middle East and North African countries? How do you see that playing out? The space to do that is much more restricted right now. The fortunate thing is outside the GCC, most countries, probably if you exclude Iraq, most other countries are oil importers.
So for them, a decline in oil prices is, it's helpful in that sense. They still have, needs. Countries like Egypt, a country like Egypt relies on capital inflows, and that's obviously drying up in this current environment. It's probably reversing, and it may destabilization to the currency in terms of the flows. But even a country like Egypt has built up, decent reserves over the IMF program, etc. So to answer the question, I think the potential for that is probably low, given the amount of space that is available. You might have small things here and there, but in terms of the big country, Egypt, for example, which required a huge amount of aid in 2014, that is not needed right now, at least not to the extent that was needed in 2014 before the IMF program over there.
Great, thanks, Ziad. And over to Areije, just to round out Nasser and Ziad's comments. Any lessons learned from prior crises that you think would be particular, would be especially useful in the current times?
I think it's hard to kind of compare, different crises to this, because a lot of the others were much more focused either on the financial sector or the oil kind of industry and things like that. But I think this kind of crisis kind of taps into a lot of different things. Like, not only is it affecting the economy, but the financial services industry that will have to kind of pick up the slack to help support and provide SMEs and other types of companies a lot of loans. So how that will affect the financial institutions a year later when they're being forced to kind of help kind of support these companies, but also kind of how this kind of affects how we behave as society. And I think no one kind of really talks about it. I think all of us are living in circumstances that we didn't live before. Before it was unheard of that I'm going to be spending the whole day working from home, and now it's just become the norm 3 weeks into that. And I think to your point, Dr. Nasser, before, the flexibility of a parent being able to work from home while still being able to produce and to effectively be productive was kind of shunned. So a lot of these kind of things that I think, I'm not going to say are lessons, but I think are kind of opening our minds to a lot of things. And a lot of these narrow-minded thinkers are going to kind of have to be wiped out going forward, because none of us envisioned things like this happening. A virus affecting not only our health, but also the way we, work as societies or even interact with each other. And I think, more importantly, I think it's important for us to have an open mind and to really be aware of how this is going to be affecting a lot of different things going forward, and how governments operate. And it's also an opportunity for people to collaborate, not only in rescue packages, but how we work together. Whether it's allowing businesses to passport into other markets more easily to help their growth. But, no longer, our barrier is important. Not only has this virus shown us that, this doesn't demark between different countries, but ultimately how we can maybe help combat, such situations by being more collaborative going forward. So I think it's kind of lessons that I'm learning from this crisis that I think, we avoid because in previous crises, because we're able to kind of have more control over the situation. I think because there's no precedence for this, I think we need to start to have more of an open mind and to be able to absorb that we might not know the answer, but we need to be able to be open to see whether we can adapt to new situations.
Great. That's a good optimistic note. And I guess I'll carry that optimism over to the last topic of discussion today. We've had many questions online and via email. I'm very sorry I can't keep up with everyone and have all of those addressed, but there were a few questions that talked about the big news in the town, the oil price war. This question will be for Ziad and for Nasser. How optimistic are you about there being a truce, or at least a new pact, or at least a truce between Saudi Arabia, Russia? What role is there for the U.S.? And how do you ultimately see the movement in the oil markets impacting the region that we're here to speak about today, the Gulf Arab states? big questions. We don't have a lot of time to answer them, so I turn it over to you to do your best in a few minutes, and take it away, Ziad.
Sure. Obviously, we're going to find out later this week whether we're going to get an agreement on cuts, whether it's going to be broad-based, including OPEC and other producers. But I think the big picture is as follows. We had in 2016, late 2016, there was an agreement reached between OPEC and Russia to cut output and support prices. That agreement was successful. It lifted oil prices above 55 for most of that period, $50 per barrel. But it came at a cost. And the cost was that these countries, OPEC especially, had to increasingly reduce their output. So Saudi Arabia started with a production of 10.3. That was reduced to 9.8, went to 9.7. And before the recent price war was even considering going to the late 9s or even below 9 million barrels a day. So that came at a big cost. So it's clear that this kind of an agreement that requires sustaining oil prices at the expense of an increasingly lower market share was not sustainable. And we're going to probably shift to the next stage, which is an oil price war. The unfortunate thing is that the oil price war happened in the midst of the massive demand shock from the coronavirus, where we're all staying at home and not commuting. So there's a massive shortage of demand in that sense. Nobody's flying anywhere. That creates a shortfall in demand for energy. And the combination of the two was not helpful to oil markets, and it's not helpful to regional economies. I think it makes sense for now to reach an agreement to eliminate at least the supply element of the reduction in oil prices. And once markets stabilize, and in any case, the decline in oil prices due to demand will filter out some of the high cost producers. That's enough to make some of the high cost producers leave the market. But I think once markets stabilize, once we get over the coronavirus shock and the lockdown measures, I think we're probably going to return to some form of price war, market share war to gain market share, simply because nobody was you didn't want to sustain prices at the expense of your market share. But that's probably going to come further down the road.
Thank you, Nasser.
Well, I think yes. Let's face it. And since you're in the U.S., the agreement, the OPEC Plus agreement with Russia, effectively made space for the U.S. shale oil industry to take market share. And that's exactly what's happened. And that's accelerated. You've gone from more than 40% to less than 34% for OPEC. So it's very clear that you're going to get into a price war because Russia was viewing the US as taking more and more of its share in the market. But the deeper issue is strategically and from a game theory point of view, when do you address the issue of shale oil? Do you wait a few years down the line when shale takes an even greater share, or you fight them now and get them out of the market? I think the decision was, let me fight them now and get them out of the market by lowering prices. But there's also a deeper problem, namely the competition you have from renewable energy. We've seen the costs of renewable energy, solar, wind, etc., decline by some 80 to 90% over the past 7-8 years. So renewable is now directly competitive with oil and gas. So you have every incentive to try to sell as much of your oil and gas, but also to privatize it. The Aramco privatization was a relatively small one. Eventually, the GCC countries need to think down the line, what am I going to do with all this oil and gas, and avoid the oil and gas reserves becoming stranded assets because the price is going to go down so much, it no longer pays me to extract the oil. So it pays you right now to privatize as much of your oil and gas reserves, the Aramco example, but also try to drive out competitors, particularly shale oil. So that is not going to go away. Even if you have an agreement, which I doubt, you might have some reduction. But what does it mean to reduce by 1 million? President Trump on TV the other day was talking about a reduction of 10 million barrels. That is impossible to achieve. Nobody is going to, they couldn't agree on 200 and 300,000 barrels reduction. There's no way anybody is going to agree to a 10 million barrel. I mean, that's outlandish. So at best, you can agree maybe on some reduction, but that is a very moot point in a market which has collapsed because of lower economic activity, because of low transport, air and road transport. So even if there's an agreement to reduce output, you're not going to have much of an impact on the price. So this is a long-term, a medium and long-term problem. The price war was going to happen. If it didn't happen now, it was going to happen later.
We have plenty to talk about there, and after Thursday, I think we'll have enough content for perhaps a whole nother program just on that last question. So with that, I'm going to bring things to a close. I want to extend my thanks to Areije, Ziad, and Nasser for joining and engaging in what was a wide-ranging and discussion of very complex dynamics, but I think three of you handled it brilliantly. So thank you very much, and thank you to the entire audience for joining us. Please visit us again, tune in again for more virtual events in the future. Thank you very much.
Thank you so much.